Ladies and gentlemen, good day and welcome to Sansera Engineering Limited Q4FY23 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Seema Sehgal from ICICI Securities Limited. Thank you, and over to you.
Thank you, Venju. Good morning, everyone, and thanks for joining us today. We have with us the management of Sansera Engineering Limited, represented by Mr. B.R. Preetham, Group CEO, and Mr. Vikas Goyal, CFO, Mr. Praveen Chauhan, COO. Thanks to the management for giving us this opportunity to host the call. Now I would like to hand over the call to the management for the initial remarks. Over to you, sir.
Thank you. Good morning, everyone. Welcome and thanks for joining this call. On this call, I am joined by our CFO, Mr. Vikas Goyal, and our COO, Mr. Praveen Chauhan, and our Investor Relation Advisor, SGA. The results and the presentations are uploaded on the stock exchange and the company website. I hope everybody has had a chance to look at it. I am pleased to share that we finished another year with our best ever annual performance in terms of top line and profitability matrices. The momentum is set to continue as we begin the current fiscal year on a high note. Both the domestic and international markets are showing recovery, which bodes well for our auto and non-auto end sectors. Amongst the key development in the quarter, I am very proud to share that Sansera has recently been certified as Great Place to Work in India. This certification signifies building and sustaining a high-trust, high-performance culture in the company. We continue to be recognized by industry for delivery, development and quality performance, and we have received multiple awards in this area. On the strategic front, we made an investment in MMRFIC, which is a research, design and manufacturing entity, building subsystems for next generation radars by leveraging machine learning with artificial intelligence and millimeter wave sensors with hybrid beam forming capabilities. This transaction provides us an opportunity to reinforce our strategy of diversification and collaborations. MMRFIC's team of experts and years of R&D experience in the radar space sets it apart and made a compelling investment case for us. The strategic investment in MMRFIC will help Sansera enter into high technology space and have access to a strong R&D engineering team which can address our priority segments like defense and aerospace. It has also the potential in telecom and automotive, especially in autonomous driving subsystem technologies in the future. This alliance is expected to provide both parties with significant future growth prospects. Coming to our performance in the quarter, we registered a 78% increase in our auto tech agnostic and xEV products. The demand for EV two-wheelers is rising at a fair clip. Our tech agnostic products are also doing fairly well, with good traction in order inflow for aluminium forged components. All the 3 press lines which we have commissioned are fully booked now. We are also adding another 2,500 ton plus for the aluminium components. This segment contributed 11% of our sales, of which 6% came from auto tech agnostic products and 5% came from xEV products. With the upcoming change in BS norms, our ICE sales registered a marginal decline of 3% during the quarter. This decline was seen across two-wheelers, three-wheelers and passenger vehicles. Performance for motorcycles was flat, whereas HCV registered a growth. This segment contributed to about 75% of sales, of which 33% sales came from motorcycle segment. Scooters accounted for 6% of the top line. Passenger vehicles accounted for 22% of the top line. Commercial vehicles, which accounted for 13% of the top line. A significant portion of sales has come from our Swedish subsidiary in this segment. In commercial vehicles, we witnessed 18% growth on a year-on-year basis and 25% growth on a Q-on-Q basis. I would like to highlight that we have changed our reporting. Previously, we used to talk about auto sales mix along with tech agnostic and xEV products. However, numbers starting from this quarter pertain to auto ICE only. Our non-automotive segment grew by 50% in the quarter. Talking about the sale mix, as guided previously, we crossed 900 million milestone for our aerospace and defense business in FY23. In this quarter, it contributed about 4.9% of our sales, registering a strong 76% year-on-year growth in the quarter. With our new facility, which is now fully functional, we expect a stronger growth in the coming year. Off-road sales were in the region of 4.7%. Demand is coming very strongly for this segment as well. Agriculture accounted for 2.5% of the top line, and remaining 1.8% of the top line came from few other segments. With all the above put together, non-auto segment contributed to 14% of our sales. Coming to our order pipeline, as of March 31st, 2023, our order book of new business with an annual peak revenue stood at 13.3 billion rupees, with auto ICE contributing to 5.5 billion, which is about 41% of the total order book. Auto tech agnostic and xEV adding to 4.3 billion, which is about 33% of the total order book. I would also like to highlight that for aluminum forged components, we have about 58 component orders from 13 different customers. And non-auto accounts for about 3.5 billion of the order book, which constitute about 26%. This is post our reset. We do reset our numbers at the beginning of the year, wherein we would move our products which have started the mass production into the mass production cycle. So the numbers that I told you, which is 13.3 billion, is post the reset. Until a few years ago, we never had a dedicated business development team. However, with our entry into newer areas of business, now we have an established business development desk which is proactively involved in securing new businesses from newer sectors and for the newer components as well. And their efforts continue to pay off as we are seeing good order inflows across all the sectors. Our international order book is also expanding as a result of the momentum in our aerospace and defense division. At this point, I would like to take a step back and reflect on our journey. Sansera has been in business for 4 decades, the first 3 of which were spent establishing a leadership position in the ICE area and becoming a major supplier of connecting rods and rocker-arms for global and domestic players. With this position of leadership secured, we started our non-auto journey. In the past few years, we have also introduced a variety of tech-agnostic and xEV components. With these persistent efforts, we have been able to outpace the industry and achieve considerable progress towards our long-term vision. I am glad to share that we have surpassed our estimates with respect to our tech-agnostic portfolio. As a result, we refocused our vision and raised our long-term sales contribution targets from xEV and tech-agnostic products from 15% to 20%. Effectively, over long term, we are looking at an auto ICE contributing to 60% of our top line, while 20% each coming from non-auto and xEV and tech-agnostic portfolio. Going forward, we are geared towards an even better FY24 as domestic business continues to remain healthy, and on the international side, we are seeing signs of good recovery both on exports as well as our international business to our Swedish subsidiary. I would now hand over the presentation to our CFO, Mr. Vikas Goyal. Vikas.
Thank you, Preetham. Good morning, everyone. Welcome you all. I will briefly cover about the financial performance during the quarter. During Q4 FY23, our total income stood at 6,230 million rupees, representing a 7% growth on a year-on-year basis and 10% increase sequentially. If we look at our performance year-on-year basis, domestic markets outpaced the international business. However, sequentially, we have seen a recovery in our international business, which is a positive development. After experiencing some degrowth in the previous quarters, sales at our Swedish facility is now approaching closer to the normal levels. The Q4 gross margins at 39% had an impact of approximately 100 basis points by one-time year-end adjustments, including the inventory provisions and some customer-related costs. These are one-time and do not represent our run rate margins. Employee expenses saw an increase of about 9% on a year-on-year basis, which represents the annual increments and volume increases during the quarter as against previous year same period. Other expenses at 583 million were in line with the last quarter and represent a run rate. Overall, our EBITDA margin for Q4 FY23 stood at about 16.2% versus 17.2% during Q4 FY22, and for the reasons explained in the gross margin section. Finance costs for the quarter increased to rupees 173 million as compared to rupees 147 million in the corresponding quarter in FY22, largely due to increase in the rate of interest that we have seen over this year and the higher working capital borrowings that we had to do for business expansion. Our cash profit after tax of 701 million in Q4 23 was stable against the same for last year at 701 million. In terms of geographic sales mix for Q4 FY23 stood as follows: India 68.4%, Europe 18.5%, USA 9.2%, and other foreign regions 3.9% as a percentage of total revenues. In the next year, we are looking at better numbers in terms of international business mix. Looking at the full year numbers, as guided in the last quarter, we closed the year with a 18% growth in total income amounting to 23,560 million, which is also the highest revenue ever achieved by the company. Our EBITDA stood at 3,948 million with a margin of 16.8%. This included these one-time adjustments that I mentioned in the quarterly section. Net profit was 1,483 million as compared to 1,319 million in the previous year. We generated a cash profit after tax of 2,784 million versus 2,516 million in the last year, and a net cash from operating activities at 2,558 million, which is 79% of the EBITDA for FY23 as against 73% during FY22. So, which is a healthy cash conversion of profit. On the debt front, our net debt stood close to 6,505 million as on March 2023. I'm happy to share with you that the Board of Directors has recommended a dividend of 125% of the face value at rupees 2.5 per share for the financial year 2023. Capex for this year stood at 2,440 million. This was mainly to enhance the technological upgradation and add production lines to support our growth in the non-ICE segments. We expect to spend a similar amount in the current financial year. On the capex front, we have kickstarted construction of a new aluminium machining parts facility at our existing plant 11 in Biddi. This is a brownfield expansion project which is expected to get completed by the end of this year, and it will help us further improve our presence in the tech agnostic and XEV segment. With this, we conclude our formal presentation and open the floor for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Moksh Mandalesha from Anand Rathi. Please go ahead.
Thank you, sir, so much for the opportunity, sir. Sir, gross margin was lower this quarter sequentially. Can you explain more what kind of one-offs this was, sir?
So as I explained, there were primarily two types of one-offs. One was the inventory provisioning. So we reviewed our inventory provisioning policy, especially because we used to only provide for semi-finished and finished components, or rather WIP and finished components. We took a more conservative approach and started providing for the raw materials as well, which was included in this. Secondly, there were some customer-related costs for previous quarters or previous periods, which got identified during this period and adjusted.
Got it. So how different would be the margin and return profile for the aerospace and the defense segments? Also, similarly, as the mix for tech agnostic and XEV products are increasing, how would the margins and return profile be different for this also?
Hi, Preetham here. So, aerospace and defense, as we have also previously said, are very similar to our export margins, where we say that on a gross margin level we are about 10% better than our domestic mix, which probably translates to about 6 to 7% EBITDA margins, higher EBITDA margins compared to our domestic profile. So I think this would give you, but while defense is a very small portion of the whole mix, primarily currently the major revenue is coming from the aerospace business, which we expect also to have a significant growth this year as well. Now on tech agnostic and XEV components, as previously communicated as well, we follow most of these customers. Ours is a mechanical forged and machine precision component category. It's no different to our component category which we do for ICE as well. So we follow the similar activity-based costing. So the margin profiles are very similar to our current product portfolios.
Thank you. So how would be the ramp up of this 13.3 billion orders over the next few years? And since the new orders have a better export share, the margin profile should be better, right, sir?
Yeah, I mean, yes. While we have said that this ramp up of we only declare, we declare the peak annual revenue of the order book, which translates to when all these orders mature, this would give an annual revenue of 13.3 billion rupees, which generally takes anywhere between 2 to 3 for the full maturity to happen. In our experience, we generally see 30 to 40% of ramp up happening in the first year, about 70% to 75% of the ramp up achieving in the second year, and third year onwards the full maturity. But when I say this, you should also note that every order has got its different ramp up cycle. It may not follow the same thing. There are domestic orders which could actually ramp up much faster, while some of the defined programs could take this path. So generally we say that the third year is when we achieve the full maturity of the products.
Right, sir. Can you share more insight on this MMRFIC technology on the products, and how do you see the revenue ramp up for this business over the next few years?
Yes, MMRFIC, as I explained, that this is primarily a R&D facility. These were started by technocrats who came out of primarily from Texas Instruments, and about 7.5-8 years back. All the promoters are bootstrapped, and they have been working on this technology which has been developed in millimeter wave radars. This works on between 30 gigahertz to 110 gigahertz, which is primarily between K and W band. And these technologies are not fully available in India. Currently, these technologies are being imported either from Russian countries or from Israel or from US. So these are the technologies today which are being used currently by both defense and non-defense applications. In the defense application, primarily it is used in the seeking application, where the radars are used for seeking the targets and then guiding the systems. And in the non-defense area, it is also used for surveillance, primarily on perimeter surveillance, on critical establishments, also used in drone detection technology as well. Now, it is also used in electronic warfare, where primarily prior to any missile that goes, this radar goes, detects all the ground-based radars and generally neutralizes them, and then the warhead follows. So it is primarily used as in the EWA application as well. But these are very, very high technologies which are being developed from last 4 to 5 years. Most of the components of the radar are already mill tested, and it is expected to go on field testing towards the end of this year. We expect that the mass production of these would commence from next financial, towards the middle or end of the next calendar year. So we expect that MMRFIC would start generating meaningful revenues between 18 and 24 months. We have also identified their technology, the second radar which I spoke about, which is used for perimeter surveillance and surveillance. In this, some channels of this could be used for altimeters, which are used in primarily in all the aircrafts, in the space application, as well as drones and missile applications, a wide variety of applications. We have a very good client base on aerospace, so we would work with them to find out a collaboration between our existing customers and MMRFIC. And we also see potential going forward, because most of the automobile companies are also working on radar with vision for the future generation of autonomous driving. So we are very excited about this collaboration, and with the Sansera's management capabilities and wide network of customer base, we expect that this collaboration would be very fruitful. Thank you.
Thank you, sir. The last question is on the CapEx. What would be CapEx FY24, sir?
CapEx for 24 will be approximately similar, as I mentioned, about in the range of 250 crores. And this will again be spearheaded by projects which will help us to deliver the new order book, mostly in the areas of non-auto, non-ICE categories.
Got it, sir. Thank you so much, sir. Opportunity, sir.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Also, to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Siddhartha Bera from Nomura. Please go ahead.
Hi, sir. Thanks for the opportunity. So first question again on the margin side. So, like you said, there were a couple of one-time costs in the quarter.
Siddharth, could you be a bit louder, please?
Yeah. Is it better now, sir? Or
Yes, better.
oh, okay. So I was checking on this cost side. So will it be possible to indicate, cumulatively, how much percentage all these costs put together have come in the quarter or the one time?
It was approximately slightly above 1% for the quarter, and if you spread it across, but for enabling the growth, we have, and also as a result of the huge amount of order inflows that we are seeing now, we are required to invest heavily in terms of building capacities, and especially for the non-traditional areas of non-ICE and non-auto components, which is actually resulting in this higher capex and of course in a slightly higher debt. We expect the debt to remain around this level for some more period, although the debt metrics will continue to improve. If you look at net debt to equity or net debt to EBITDA, those metrics will continue to improve as we move forward, because this is being procured to fuel the growth in the coming periods.
Sure. Thank you, sir. And sir, my next question second question is on the revenue front. Earlier, as we have guided 15 to 17% growth, which we actually did pretty well, 18% in FY23. So what's our view for further FY24-25?
Madam, as I had seen, if you look at our business model, we have built quite a resilient business model. FY22 was a weak domestic market. Despite all the COVID pressures, weak domestic market, we were able to grow because we did very well on our export front. Now, looking at FY23, FY23 was as we had expected because of the Ukraine war, energy crisis, continued chip crisis. The export was a much weaker from our overall contribution of 37% of our revenue from international business. It came down to almost 28%. So despite that, we registered a healthy growth of almost about 17%. Now, going forward this year, we have already seen recovery in exports. We are looking at a much stronger performance in our non-auto business, which also is expected to grow at about 50%, especially aerospace, on a year-on-year basis. With all these things, we are quite confident, both domestic and exports, to do well, and we expect that we will do better than FY23 in terms of percentage growth.
Okay, thank you. And sir, if you can update us about the plan that we have planned to coming up by 25 in North America on a lease basis initially.
The plans are quite underway. We have we have had some more visits to some potential sites. We expect that towards the quarter 3 of this year, we would finalize the place and commence taking steps towards establishing this facility, which would be a lease front. We expect that this would be the first step towards setting up some manufacturing portion of this, because now strategically what we have decided is to cater to specific customer requests. We would put up final operations, including assembly and inspection and few final operations there, while we would cater majority of forging and machining, green machining from India. So with that strategy in mind, we expect that towards Q3 we should finalize the space and the place to start.
Okay, thanks a lot.
Thank you. Next question comes from the line of Vinod from SKP Securities. Please go ahead.
Hello, good morning.
Good morning.
My first question is answered about the exports. I just want to ask about, can you give some color on how the aerospace business is going on, and have you received any major orders in that area?
Yes, aerospace business is, as I said, that after 2 years of lull, it has done pretty well last year. Our aerospace went up by almost 50%, 55%, and we expect a similar growth or slightly higher growth this year as well. We have confirmed orders for that. Post next year also, we expect that we already have a visibility of close to about $12 million, which is out of which very few are expected to add to the revenue for this year. So we are looking at a very, very strong growth coming from aerospace in FY24 as well as FY25. Now, to cater to these growth, we have already set up a new manufacturing facility in anticipation of this. We are also working on several new initiatives, including we have recently concluded on appointing a very dedicated senior person for Europe region who's based out of Toulouse, and he is going to be focusing on working with European customers and aerospace. So for us, aerospace, we expect that this new facility we should be able to fully utilize in FY26. Wherein once it is fully utilized, it should give us a revenue of anywhere between 350 to 400 crores.
Yeah, perfect. Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question and restrict yourself to 2 questions. The next question comes from the line of Vaibhav Shah from ICICI Prudential Life Insurance. Please go ahead.
Yeah, thank you. Good morning, sir. So,
Morning.
My first question is primarily on the Sweden business. So, if I look at the quarterly numbers, consolidated minus standalone, on a sequential basis, even though our revenues have come in better, our profitability has gone down. And even on a YY basis, our profitability seems to have taken a bit of a hit. So can you let us know what exactly is happening in this Sweden operations, and at what level of utilization can we expect this profitability to improve? That's the first question.
Yeah, the Sweden, Vaibhav, we had said that last year FY23 Sweden would see a degrowth because of change in business strategy from our principal customer. While on few of the programs we were a single source, and few of the programs another competitor was a single source. To de-risk the business, they wanted to allocate 30% of our business to them and 30% of their business to us. While our product categories was a mass production number, so they wanted to take up that first. So our product, 30% of our products was given to them, and in this year we would get 30% of their, which we have already started. So Sweden, while all the fixed overheads remained intact, so this resulted in a dilution of margin, and we expect that this year most of it would be recovered, and we are taking up some more cost improvement initiatives as well. So with that, we expect we would be back to about 7 to 8% EBITDA, and probably towards the last quarter we should be able to reach towards a double-digit EBITDA in this year.
Sure. That's helpful. The second question is on the order book, right? So you have highlighted that for the March quarter we have a new order, annual peak revenue of 13.3 billion. I just wanted to know that is there any orders which are probably being closed, or are they going down because of this EV shift which is happening in two-wheelers, or probably shifted? So what's the net order? I mean, the annual new orders you have given, but are there any orders which are being closed down and which have not been renewed? And the net order book, if you can highlight.
You mean on our regular business, what has been closed down? Is that the question, or in the new order book, have we lost anything? Is that the question, Vaibhav? I just am a bit confused.
On the regular business, which there is any...
See, generally, the regular business, this order book does not include any of the replacement business. So if there is a model change which is going out and we are nominated for the newer model which will replace the existing model, we do not take that into our new order book, because that's only a replacement business. When we mean new orders, it would be only, just to give you an example, if Maruti recently introduced Gemini. Gemini is a new order for us, where this would be added into the new order book, while the new Alto is replacing the old Alto, so that would not come into the new order book. So except for one component, which is a rocker arm for Maruti, which was going in FID and G10 engines, which got replaced with the newer K series. In March, we did our last rocker arms for Maruti. So, it's kind of a historic day for us, because this component was the first component that we started, and it lasted for almost 4 decades, where we were all, for most of the more than 3 decades, we were single supplier to Maruti as a 100% share of business. So apart from that, nothing else has ended.
Okay. So this, we should take it as a fully new orders and no replacement orders.
Absolutely. Whenever we say that new order books, it only means that these are additional orders, nothing to do with model replacements. If we get any of the model replacement, it would only go as a replacement. It doesn't come into the new order.
Understood. And my last question is on the exports. So can you highlight what is the export mix? I mean, between autos or probably autos and non-autos for us?
Export mix for the previous year or export mix for the coming year? What was the question?
I mean, if there is a significant change, and you can highlight for both FY23 and what it could be for FY24?
Exports for FY23 was close to about 28.4% of our product sales was from international sales, out of which about 21.7 was from sales from India, and 6.7 was primarily international sales, which is coming from Sweden plant, and this 28.4 would go up to 32.5. 32.5. Primarily, all the growth is coming from exports from India, and this also includes that a very strong aerospace. As I had said, that aerospace we are expecting almost close to 60% growth this year. Also, there is aluminium forged and machined components which has started commercial production, which is being exported to Europe. So all these are going to result into a much better export mix for the coming year.
Right. I was more so looking at the export mix within this 28%.
Within the exports for the so can I come back to you with that answer in towards the end of my other thing? I will answer that question. I'll just pick up the numbers and tell you.
Yeah, sure. That's it from me. Thank you.
Yeah.
Thank you. Next question comes from the line of Shashank Kanodia from ICICI Securities Limited. Please go ahead.
Yeah, good morning, sir. So just wanted to check how sooner can we attain this 20% kind of a margin trajectory? Is it something on the cards over the next 2 years?
Pardon me, please repeat.
Sir, how sooner can we attain this 20% margin trajectory in terms of EBITDA margin? So is it something on the cards over the next 2 years? It is something which we endeavor to achieve?
Absolutely. We have taken up, company-wide program for 2020 on the 320s that we are working on. Of course, we would like to maintain 20% CAGR growth, a 20% ROS, and 20% EBITDA margin. We are quite confident that, as you rightly said, that with the current order book and the current market scenarios, not accounting for any unexpected thing, we should be able to progress towards that number.
Okay, so by FY25, we should expect us to clock 20% margins. Is it something?
I would really like that to happen while we are all working very focusedly towards achieving that.
Okay. Secondly, sir, coming to some other data points that you shared on slide number 6, so is it fair to assume that we have underperformed the domestic auto industry, auto ICE industries, by going just 9%, whereas the industry grew roughly high double digit?
Which slide are you referring to?
I'm referring to slide number 6. When you mentioned auto ICE growth for us being 9%, right? Whereas in the industry grew healthy double digit this year.
No, please to understand, this also includes our degrowth in exports. Because while the significant degrowth has come from auto ICE in exports in the previous year, while our domestic growth in auto ICE has been, very healthy. If you would like to understand what is our domestic growth in auto ICE, I'll just give you that number. Yeah.
Fine.
Basically, if you look at our growth in the domestic markets for automotive markets, we grew our business by about 29%, absolute terms.
Okay.
Yeah, 29% in two-wheelers, 39% in passenger vehicles, almost flat in commercial vehicles, and marginal negative in three-wheelers. So on an average, both these are very relatively smaller percentages in the overall revenue. But broadly, if you see two-wheelers and passenger vehicles, average growth is about 29%.
Right, sir. And sir, lastly, coming about auto IC share of revenues between two-wheelers, passenger vehicles, and commercial vehicles. So it's more tilted towards two-wheelers, right? And the year-on-year contribution from passenger vehicles and commercial vehicles has declined. So is this the direction that we're heading to, or there is a one-off, and even there the exports have played a component?
No, so basically I would like to put it slightly differently. The share from passenger vehicles has not declined. Rather, the share from two-wheelers has increased because we added a new customer during the FY22, which got matured volumes during FY23, which has actually improved the share of two-wheelers, which is one of the prominent OEMs in the Indian market, which was not our customer earlier.
No, we also have, as you rightly said, one is that, and second thing is there is an impact on exports also. The exports passenger vehicle contribution is significantly higher, but you would see that this year with addition of mature business from Tata Motors, which we had added towards the second half of the last year, and a better export mix, the passenger vehicle returns would be quite healthy this year.
Sure, sir. Thank you so much, and wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you very much for all your patience hearing and all the questions. And I would just like to say that while we have taken up the sector expansion, as I said, that we have built a business which is quite resilient, and with the current positive growth story coming from both domestic and exports, and all our newer plants are coming into fully operational mode, we expect with better utilization, this year would be a much strong year in terms of growth as well as in terms of margin. So we look forward for meeting you all people again, and any clarifications on questions that you would have, you could reach out to our IR partners, SGA, or directly to us. Thank you again, and wish you all the best.
Thank you.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.